Good afternoon, everyone. Welcome to our Research and Development Tax Credit for the Life Sciences Industry webinar. KBKG was established in 1999. We have offices across the U.S., including Illinois, Pennsylvania, Arizona, Ohio, Georgia, New York, Texas, and Pasadena, California, where we are headquartered. We provide turnkey tax solutions to CPAs and businesses. Our engineers and tax experts have performed thousands of tax projects, resulting in hundreds of millions of dollars in benefits for our clients. Our team is a diverse mix of tax specialists, attorneys, and engineers from various disciplines. This combination of talent allows us to be the best at what we do and maximize results for our clients. KBKG is a preferred provider for thousands of CPAs across the country. Now I'm going to introduce our presenters. Paul McVoy is the director in KBKG's R&D tax credit consulting practice. He has more than 10 years in public accounting, leveraging previous tax compliance and tax provision work experience to provide focused and thoughtful advice regarding the research and experimentation activities of his clients. Paul has managed research credit studies and consulted for numerous companies throughout the country, working closely with engineers, scientists, software developers, and C-suite personnel in a wide range of industries. He has successfully represented clients in tax controversy related to their research credits claims. Industry experience includes, but is not limited to, venture capital, software development, aerospace and defense, semiconductor, gaming, food and beverage, agricultural and engineering, cosmetics, pharmaceutical and biotechnology, and medical device. Michael Maroney is the Senior Manager of KBKG and advises clients on tax matters related to federal and state research and development tax incentives. He has 20 years of experience working on tax reviews ranging from sophisticated multi-year claims to short-term consulting projects. He has advised numerous Fortune 500 clients across a variety of industries, including aerospace and defense, manufacturing, agricultural, pharmaceutical, communications, industrial products, consumer goods, software technology, and energy. Now, I'd like to turn the presentation over to our speakers.
Thank you, Diana. So here's the agenda of the items that we're going to cover on this webinar. What we'll do is we'll start with the benefits of the R&D tax credit. Next, we'll discuss what's new, and then we'll provide an overview of the R&D credit and how to maximize the incentive's value. We'll wrap up by discussing other considerations when claiming the research credit. Finally, I would encourage you, as Diana suggested, to submit your questions in the chat box, and we will answer as many as we can. So let's go ahead and get started. So the Section 41 credit for increasing research activities was originally acted in 1981. At the time, it was a temporary code section, and it stayed that way until it was permanently extended as part of the PATH Act of 2015. The Section 41 credit is a federal statute. However, most states also offer some form of research credit that borrows from the federal statute. And although there are billions of dollars worth of R&D credit claims every year in the United States, there are still billions of dollars of credits that go unclaimed. The Section 41 credit is a general business credit, typically ranging from 6% to 10% of qualifying research expenditures. Because it's a general business credit, it provides a dollar-for-dollar reduction in the taxpayer's income tax liability. So pass-through entities such as S-corps and partnerships can also claim the credit. The benefits will flow through to the individual shareholders on each shareholder's respective K-1s. The R&D credit can be claimed for all open tax years under the statute, and unused research credits may be carried back 1 year and forward for up to 20 years. Some additional benefits is increase on research, increases the return on investment, it lowers the effective tax rate, and it improves earnings per share. Also, retroactive claims can be made. So all open tax years, like I said, within the statute, but they could be even in a closed tax year. If the company's in a net operating loss, you can go back and claim the credit and then adjust your carry forwards accordingly. So I think I'm going to turn it over to Paul now. He's going to talk about what's new with the R&D credit.
Thank you, Michael. Next, we'll explore recent legislative developments impacting the life science industry. This includes the enactment of the Tax Cuts and Jobs Act, the IRS LB&I Research Credit Directive, and the passage of the Protecting Americans from Tax Hike, or PATH Act. So on December 22nd, President Trump signed the 2017 Tax Cuts and Jobs Act, which is the most sweeping update to the U.S. tax code in more than 30 years. Many of the provisions of the Tax Cuts and Jobs Act significantly affects the life science industry. Taxpayers and CPAs should analyze how their federal and state tax calculations may be impacted. So over the next few slides, we'll discuss the provisions within this act impacting the orphan drug credit, repeal of the Section 199 domestic production activities, or Section 199 deduction, and the treatment of research and experimental expenses for tax years beginning after this year. So enacted in 1983, the orphan drug tax credit provided an incentive for pharmaceutical companies to seek treatments and cures for rare diseases affecting Americans. An orphan drug is a drug developed to specifically target diseases that affect only a small percentage of the U.S. population, less than 200,000 people. And since the passage of this Orphan Drug Act, more than 480 orphan products have been approved related to the development of more effective formulations and new indications, among others. Historically, the orphan drug credit provided a 50% credit for qualified clinical testing expenses in accordance with Section 45C. With the new tax overhaul, the orphan drug credit has been dramatically reduced from 50% to 25% of the amount of clinical testing expenses for the tax years beginning after December 31st, 2017. Moreover, the legislation provides taxpayers the ability to elect a reduced credit under Section 280C in lieu of reducing the allowable deductions. This is consistent with the 280C election available for taxpayers claiming the research credit, which I believe Mike will talk about later. But in order to avoid providing a double benefit for the same expense, Section 280C requires a taxpayer to either reduce their deductions by the amount of the credit or to elect a reduced credit. The reduced credit is calculated by multiplying the credit generated by 1 minus the top corporate tax rate. For the 2017 year, that would have been 35%, and moving forward or prospectively, that should be 21%. So the next item we're going to talk about is the Section 199 deduction. Instituted in 2004, the 199 deduction, or DPAD, allows a taxpayer to take a permanent deduction equal to 9% of the lesser of qualified production activities income, QPI, or taxable income. The deduction, however, may not exceed 50% of W-2 wages paid by the taxpayer during the applicable year. So the passage of the Tax Cuts and Jobs Act repeals Section 199, or DPAD, deduction effective for years beginning after December 31st, 2017. One thing to note is 199 may still be claimed for any open tax years beginning before January 1st, 2018. So accordingly, taxpayers with production or service activities that are within the scope of Section 199 should consider claiming the 199 deduction for current years, or possibly reviewing claims made in prior tax years to take advantage of that permanent benefit. So life science companies may benefit from an increased focus on 199 for planning purposes, so we should ensure that we're maximizing this benefit before it's permanently repealed. So if we're building out any property or developing software or digital capabilities, automating or digitizing different facets of our business, which may be eligible for 199, is something to speak with your CPAs or tax preparers about during your tax planning for 2018. Next, we'll talk about the significant changes to the treatment of research and experimentation expenditures by the Tax, Jobs, and Cuts Act. Before tax years beginning December 31st, 2021, taxpayers had the option of treating research and experimental expenditures under Section 174 on their returns. Currently, the two options available for taxpayers were to directly expense the R&E expenditures when paid or incurred, or capitalize and amortize them over no less than 60 months when the taxpayer first began to derive benefit from the R&E. However, under the TCJ, the Tax Cuts and Jobs Act, taxpayers will have far fewer options and less flexibility in treating these expenditures. For example, for tax years beginning after December 31st, 2021, taxpayers will be required to treat R&E expenditures as chargeable to a capital account and amortized over 5 years. This will be 15 years for purposes of foreign research. And Section 174 will be modified to require that all software development costs be treated as R&E expenditures. The law's 5-year amortization requirement could have a dramatic effect on taxpayers currently deducting their R&E expenditures under 174, and taxpayers with significant foreign research will feel an even greater impact, as the provision provides a much larger recovery period of 15 years. So that's something to keep in mind when thinking about operations and tax planning moving into the future, of whether or not we're going to incur these previously deductible 174 costs, or moving forward projects that were scheduled to begin after 2021 to take advantage of the direct expensing. One other item of note that I think is important for individuals in the life and companies in the life science industry is that historically taxpayers were able to write off the remaining basis of any project that was abandoned or disposed of. And ultimately now the new rules do not prevent that deduction from R&E purposes. However, what they'll have to do is end up amortizing or depreciating that project until completion. So we can't take that abandonment deduction like we had in the past. So on the next slide, we'll talk about the LB&I directive related to ASC 730. So this directive provides LB&I examiners guidance regarding the examination of research credit claims. The directive is intended to provide an efficient manner of determining qualified research expenditures, or QRE, for taxpayers. So any taxpayers that are reporting ASC 730 R&D costs under GAAP on their certified audited financial statements may use this safe harbor of sorts. The IRS guidance allows taxpayers to take advantage of the safe harbor, which basically is an adjusted amount of their ASC 730 R&D costs, and which will be treated as sufficient evidence of QRE for tax controversy purposes. So what is in this LB&I directive? Basically, from a wage standpoint, which generally will make up the largest portion of costs from an R&D credit, for R&D credit purposes, any qualified individual contributors or first-level supervisors, the safe harbor amounts to taking 95% of the taxable wages for any of the work that they're performing. So again, at a high level, if we have a cost center that rolls into our ASC 730 or R&D cost or financial statement line item, if we have individuals who are performing R&D and do not have any direct reports or are the first level supervisor, we could take 95% of their taxable wages, and that will fall under the safe harbor. The second portion of the wage, the second part of the wage portion of this directive is for upper level managers, meaning that up to 10% of the amount computed for individual contributors or first line supervisors is eligible as a safe harbor for upper level managers. One key insight that is an important takeaway from this directive is that we do not have to, it's not an all or nothing approach. For example, we can take 95% of the qualified individual contributors or 95% of the first level supervisors, but elect not to take the upper level manager safe harbor. Meaning if we have a better way, or based on our facts and circumstances, of calculating the QRE associated with the upper level managers, then we're able to continue to claim those costs in the manner that we deem most appropriate and most reflective of the R&D that's being performed. We just will not have that safe harbor in the event of any sort of tax controversy in the future. So that's something to keep in mind when considering whether or not to implement this directive. Another key item to note is that in order to apply for this safe harbor, there are certain things that the exam team will request from a taxpayer, including a completed disclosure statement or a certification statement, which is Appendix A. Appendix B will be the reconciliation of Form 6765 QRE or qualified research expenditures to the adjusted ASC 730 financial statement amount. Appendix C will be the computation of adjusted 730 financial statement R&D costs. And then finally, Appendix D, which is the adjusted 730 financial statement R&D wage detail. So moving on, an item that is a bit less new than the recent sweeping tax changes, the PATH Act of 2015, but there were three very important changes to the R&D tax credit that apply to the life science industry. First and foremost, the credit has been permanently extended, which allows taxpayers that have traditionally taken advantage of the credit to continue to do so. The second big change is that the R&D credit can now be used to offset a portion of payroll taxes for qualified small businesses. This is something to keep in mind, and we'll talk about, I believe, on the next slide. But lastly, qualified businesses can now use the R&D credit to offset alternative minimum tax. So effective for tax years beginning after December 31st, 2015, qualified small businesses can use up to $250,000 of research credits to offset a portion of their payroll tax, and this will be on an annual basis. So a qualified small business is defined as a person or an entity with less than $5 million in gross receipts and no gross receipts before the 5-year period ending with the current period. For example, if a taxpayer wanted to make the election in 2020, the taxpayer could not have had gross receipts prior to 2016. If the taxpayer had gross receipts in 2015, this particular taxpayer could not make the election in 2020. Another thing to keep in mind is that taxpayers cannot make the election for more than 5 years, and gross receipts are not required to make the election. Therefore, a company that has had no gross receipts but does have payroll taxes and a research credit can make this election. So if a company is not a partnership or an S corporation, only the amount of R&D credit carry forward can be applied to offset the payroll tax. The election starts in the first quarter after the federal return is filed. If a taxpayer files their 2017 tax return in March of 2018, the election will apply to payroll taxes beginning in the second quarter of 2018. So startup companies, obviously in a multitude of industries, but certainly in the life science industry, can take advantage of that. So if we have a startup that's in biotech or software development company servicing the life science industry, and they're obviously getting rid of cash from a payroll tax liability standpoint, this would be a huge benefit for them. Not only will they be able to get a refund on all the payroll taxes that they've paid each quarter, but that will continue in perpetuity until the research credit is exhausted. So we've had a lot of clients that we've assisted not only filing their tax return with this payroll benefit, but also amending Form 941s to claim the credit if they had not taken advantage of it in the first quarter after they filed their tax return. So something to keep in mind, if we might be in an NOL position, or we might be in an AMT position previously, where we were unable to realize any of the benefits of the credit. And if we weren't able to realize the R&D credit benefit, but we qualify as a small business, we will be able to utilize the credit against payroll taxes. So on the next slide, we have an example of how the payroll tax election can help a qualified small business. In this example, a software developer began operations in 2015. The company is comprised of 15 individuals and is not expecting any gross receipts until 2017. In 2016, the company had 0 gross receipts, qualified wages of $2 million, which resulted in R&D credits of $200,000. They also had a payroll tax liability of $125,000. So this company will file their 2016 tax return in March of 2018, and prior to the PATH Act, they would not have been able to claim any R&D credit associated with their activities. But due to the passage of the PATH Act, they now can offset the qualified portion of their payroll taxes in the second quarter and then carry any unused credits forward to subsequent quarters. So one other item we wanted to cover lastly related to PATH Act is the AMT offset. The AMT provision in the PATH Act is equally as valuable to taxpayers. Prior to the PATH Act, research credits could not be used to offset alternative minimum tax. So taxpayers in AMT were forced to carry forward their credits until they were out of the AMT position. So eligible small businesses, which are defined as averaging less than $50 million in gross receipts for the previous 3 years, can now use the credit to offset AMT for tax years beginning after December 31st, 2015. Some people on this call might understand that this provision is similar to a previous small business provision enacted in 2010. And one other item to note is that the AMT reduction is not available to publicly traded companies.
So for some of you, this is going to be a brand new slide that you're looking at. For others, you may have heard about this or seen it in discussions about the R&D tax credit. But this is the tax definition of research and development. So this is a 4-part test that the project or the activities conducted on those projects must meet in order to qualify for the R&D credit. So, oftentimes when reference is made to the research and development in general. Taxpayers think about lab coats and scientists with test tubes and in white lab coats and things like that. But in reality, the R&D credit tests are much broader in application, and provided we meet the following tests, we have an opportunity to claim the R&D credit. So in order for the activities to qualify, all 4 tests must be met. Now, these tests are applied at what's called the business component level. So it's important to note that a business component can be defined as a product, a process, a technique, a software, or a formula. Now, the first test is the permitted purpose. This has to do with the objective behind the research. The objective must be to improve the functionality, performance, reliability, or quality of a new or existing business component. Now, the second test is called elimination of uncertainty, and at the outset of the project, there must be a degree of uncertainty related to the appropriate design of a business component or the capability or methodology for improving the business component. Now, the third test is the process of experimentation, and that works in concert with the elimination of uncertainty test. This requires that substantially all of the activities must constitute a process of experimentation, which is defined as the evaluation of different alternatives to eliminate the technical uncertainty identified at the outset of the project. And then lastly, the fourth test is called technological in nature. The project must fundamentally rely on the hard sciences, such as physical science or biological science, computer science, or engineering. Now, to the extent a project meets all 4 parts of the test, we're able to capture the expenses associated with the project towards the research credit. Generally, there are 3 types of expenses which qualify for the research credit. They are wages, supplies, and contract research. Now, qualified wages are generally defined as the qualified portion of an employee's W-2 Box 1 amount. There are 3 levels of qualifying activities. The primary level would be the individuals that are engaged in qualified research. These are the individuals that are working directly on the project. From there, taxpayers can capture 1 level directly above and 1 level directly below that direct research. 1 level above would be individuals that are directly supervising those personnel, and 1 level below would be the individuals who are directly supporting the personnel. Now, qualified supplies are items that are used and consumed in the research process. For example, materials used in prototype formulations. Supplies cannot be capital in nature. Therefore, taxpayers cannot qualify land or machinery and equipment. And additionally, general and administrative expenses such as travel, meals and entertainment, and telephone expenses cannot be captured as qualified supplies. Finally, qualified contract research are 65% of the payments made to third parties for performing qualified research. In order for these payments to qualify, payment cannot be contingent upon success. Therefore, qualified contractors are paid regardless of whether or not they are successful. And additionally, the credit is a domestic credit, and therefore the contractors must perform the work in the United States in order to qualify. Now, continuing on with our overview, the credit is equal to a percentage of the sum of the current year qualified research expenses, or QREs, over a base amount. So you have to calculate a base amount first, and then you get the credit on the incremental R&D spend over that base amount. Basic research payments and amounts paid are incurred to an energy research consortium. So the credit is the sum of those 3 items. It is an activity-based credit, so we often look to the employees that are doing the work or the work that's being contracted out to determine the qualified labor amount. So the activity, we go back to that 4-part test. It says in parentheses 7-part test. Which is the additional high threshold of innovation test for internal use software only. So not to confuse things, but the four-part test that I just went over is for all projects. The seven-part test would be an additional 3 tests that must be met if it is internal use software that is the business component. And then from first determine the activity, and then determine the research expenses associated with that activity. As I mentioned, it is an incremental credit, so the QREs must exceed a base amount, or at least a minimum threshold amount, in order for there to be a credit at all. And that base amount is recalculated each year. So the credit is based on there are 2 methods right now under the federal statute to calculate the credit. One is a traditional credit. That's endearly referred to as the old and cold method because it requires substantiating the base period. If the company was around and doing R&D in the mid to late 80s, it requires you to go back and substantiate that in the 1984 to 1988 period. For most of us that are on the call, we do not work for companies that are that old, and so they would fall more within the startup method, and that determines the base period is factored in for years 1994 and forward. Because that is a complicated calculation and nearly impossible to substantiate in those early years, they came up with the alternative simplified credit method, and that's available for years 2007 and after. And so what that allows you to do is to calculate the current year QREs and the 3 prior years QREs as your base amount. So your base will never be more than 3 years before your current R&D year that's going on the tax return. All right, so here's an overview of the traditional credit. So there are four items that you need in order to calculate the traditional credit. First, you need your qualified research expenses for the current year. Then you need your prior 4 years average annual gross receipts. Next, you would determine your fixed base percentage, and the fixed base percentage is defined as the ratio of aggregate QREs, those are your qualified research expenses, over your aggregate gross receipts for a specific period of time. Typically, it's the 1984 to 1988 if it's an older company, and then, like I said, if it's a newer company, it would consider gross receipts and QREs after 1994. The maximum fixed base percentage you can have is 16%. And the final thing that you need to calculate is your base amount. And so what you do is you calculate 2 numbers, and you compare those 2 numbers, and whichever is larger is your base amount. So it's the greater of your average annual gross receipts multiplied by your fixed base percentage, or 50% of your current year QREs. And then once you have got that base amount, then you subtract that base amount from your current year R&D spending, and then apply the credit rate of 20% to that. Now, for the ASC calculation, the alternative simplified credit, again, there's just 2 components that you need. You need your QREs, which are your wages, supplies, and contract research, and you need to calculate your base amount. And that's equal to 50% of your average QREs for the 3 prior years. So as you can see, the attractiveness of only having to go back 3 years in history to calculate an R&D credit is why most companies elect the alternative simplified credit method. Now, with the alternative simplified credit method, as I said, it's for years after 2007, and what you get is you get 14% of your incremental R&D spend. The rules have changed to where you can now amend your tax return into the ASC method. So if you have never claimed the R&D credit for open tax years, you can go back and amend and claim the R&D credit. Prior to like 2013, I think you had to actually go in and claim it under the traditional method, but that's no longer the case, and you can go in and amend into the ASC method. If you're a new company, relatively new, and you don't have all 3 prior years QREs, then the credit is equal to 6% of your current year QREs. Now, companies that can greatly benefit from this are those that have trouble establishing a fixed base percentage or substantiating their QREs and gross receipts for that time period. If you're a company with large gross receipts, the larger your gross receipts, the larger your base amount is. And any complex organization structures, companies that have several subsidiaries might want to consider the alternative simplified credit method. Now let's talk a little bit about who qualifies for the credit. I mentioned this earlier on, but those performing qualified activities that meet the 4-part test obviously are going to qualify. But then there's the direct supervision of those employees. So think of in terms of like a department head or a supervisor who is doing kind of splitting their time between HR functions in directly supervising personnel and doing direct research on their own. So the direct supervision portion of their time spent directly supervising qualified activity can qualify, but also direct support of employees. And I know the regulations give an example of a janitor or a maintenance staff cleaning research equipment in between trial runs or in between introduction of a new part or a new formulation. Ordinarily janitorial services don't qualify for the credit, but in that case it would, because it is directly supervising the research being done. And then as far as outside contractors, I think we talked about that, 65% of amounts paid or incurred for qualified research. These are amounts that are paid to a third party to conduct research on your behalf. Now, as far as the qualified activities, they are applied at the business component level. There is something called a shrink back rule that allows you to if greater than 80% of the activities associated with that project meet the 4-part test, then you can take the entire amount. It's called the substantially all rule. You can take the entire project as a research project and capture those costs in their entirety. If it does not, then you must shrink back your focus just to those business components that qualify. So if you have a bicycle, for instance, and there's 60% of the bicycle is not new or improved, but 40% is. Maybe it's the gear shifting mechanism, or maybe it's the brakes that you did some significant improvement on. Well, then those are your 2 business components that you can qualify, and you can qualify the supplies and the wages and the contract research associated with the development of those 2 items. We talked about the development of a new or improved product, process, software, technique, or formula. Those are the business component. That's the business component definition. For any qualified activity surrounding the design. So if there's new drugs, new compounds that are developed, medical devices, diagnostics, packaging, that can qualify. But also prototype development, the design of the prototype, and then all of the tests that are run on that prototype prior to it being released into commercial production will qualify. Testing, clinical trials, prototypes, and field tests can all qualify for the credit. Basically, if you take a step back, any activity that is from concept development all the way through to until the item is released into commercial production, there is qualified activity associated with those various stages. And another important thing here is that success is not required. So, failure is a good thing when it comes to the R&D credit, because it shows the technical uncertainty, and it shows the process of experimentation that went through to ultimately decide whether to abandon the project or not. So with that, I'm going to turn it over to Paul. He's going to discuss some qualified activities specific to the life sciences industry. Paul?
Thank you, Michael. So life science companies have to understand how trending technology developments affect product investment and strategies to meet the ever-changing patient needs. So this means an evolution to the next generation of business models and strategies. So what we have here over the next two slides are some examples of activities that may qualify for research credit purposes. Now, this is obviously isn't an all-inclusive list, but something to use as a reference after this webinar to look back on and to understand whether or not we're performing any of these types of activities or our clients are performing these activities that may generate an R&D tax credit. So a couple of things that I wanted to point out on this slide is if we're developing any sort of hardware or software systems, for example, for medical device equipment or any clinical development, that would be an example of something that qualifies. If we have any projects, or our clients have any projects related to e-commerce or business-to-business commerce, creating tools that structure and aggregate knowledge from scientific data, that would be an example of a qualifying activity. There's also an emphasis within the industry on the rapid implementation of different platforms to streamline and optimize product procurement. Again, that would be something that we would want to look at from an R&D credit standpoint. If we're trying to implement any capabilities to complement our workers, like natural language processing, machine learning, artificial intelligence, if we're applying any of those tools within a cloud framework, we are able to qualify that. Any sort of advanced methods or practices within the biopharma research environments would generate an R&D credit. And again, if we're looking at any sort of cloud biology type projects where we're using software to help with innovation and improve life science research and drug discovery, again, we want to think about, is this activity which we're already performing eligible for the R&D tax credit? So we have the qualified activities on this slide, and then on the next slide we have a few more as well, including any sort of packaging that Michael alluded to earlier. If we're working on phase 4 clinical study activities, where we're looking at a patient population that may not have been looked at before, that would be something that we may qualify from an R&D standpoint as well. And then one other thing that we've seen within the industry is any sort of 3D bioprinting or coming up with newer improved drug delivery systems will be qualifiable from an R&D credit standpoint. If we're looking at our e-commerce platform and performing any work within our IT department to optimize our websites and different tools that we use to keep track of our client base, again, talk to your tax preparer, your CPA, or if you're on that side, your client, about whether or not they've thought about the R&D tax credit and whether or not it makes sense to discuss what that benefit would be. So on the next slide, we have some examples of non-qualified activities for your reference. One thing to keep in mind is any activities that occur outside of the U.S. or one of its territories are non-qualifiable. From an orphan drug standpoint, there is a tax planning idea that if the population is not large enough within the U.S. to appropriately study the orphan drug, you may be able to claim an orphan drug credit on the foreign population. So that is definitely something to keep in mind if that's applicable. Anytime we're creating or basically duplicating something that already exists, we cannot claim credits for that. For example, if a drug is already currently on the market and we're a generic drug maker who only is taking a drug and recreating it, we can't qualify that. However, the process that's associated with creating that drug would be a business component that we may be able to claim R&D credits for from an activity standpoint. One other item to keep in mind is any funded research, meaning we're performing R&D on behalf of someone else, but we don't have any risk associated with it, and we don't retain any of the IP associated with that research, we cannot claim credit for. So again, we just wanted to highlight some of the larger items that we've seen in our experience and within the industry that are not qualifiable, as well as some of the ideas and some of the positions we can take from a qualifying standpoint related to activities we usually see.
So let's talk a little bit about maximizing the value here. We've talked about the 4-part test. We've talked about qualified activities in the life sciences industry. But there are the bullet points represented on this slide represent additional benefits that even companies that are currently claiming the R&D credit might easily overlook. The first one is bonuses and stock compensation. You might remember that what we said qualifies for wages is the W-2 Box 1 amount, which would include bonuses and stock compensation. So don't just pick someone's salary and say that that's what their qualified wage is. We've got to make sure that we're following the statute, and that is W-2 Box 1. So don't overlook bonuses and stock compensation. Also, collaboration agreements. These are we talked. We talked a little bit about companies may be collaborating with a third party. In this instance, what this alludes to is maybe you have a smaller company who's coming up with the formulation or the idea, and they just don't have the economic resources or the laboratory facilities in order to bring this idea through to fruition, and so they collaborate with a much larger pharma company, and so that would be an opportunity to look at that and understand those agreements to see what qualified activities each would be performing. Then there's contract research. If you're a company that is being contracted to do things, don't just assume that because your customer is paying you that it's automatically funded research and therefore non-qualified. We need to look at the contract, look at the agreement, see who retains substantial rights to that technology and who has the risk. Do you get paid if you're not successful? And if the answer is no, then you're at risk and you have the substantial rights to that technology. The research is yours under that contract. So don't just dismiss it because it's quote unquote funded by an outside customer. Also, we talked about direct support and direct supervision. Don't just pick the core R&D group to focus on. Broaden your scope to include those that are directly supervising that activity and directly supporting that activity. As Paul mentioned, foreign activities, particularly surrounding the new orphan drug credit rules, could, in limited cases, qualify for the credit. Also, high-level executives, just because somebody is a VP or a president or CEO of a company, a lot of these small companies, the high-level executives are the ones that spearheaded the research, and so don't just discount them because they're a C-level employee. Also, job titles. If somebody to that point, if somebody has a job title that may not appear to be qualifying, thank goodness we don't look at job titles too often to determine someone's qualified activity. We look at their qualified activity and what it is that they're doing, either in doing research or support or supervision of research. Also, non-traditional cost centers. We've alluded to the fact that sales, certain technical sales can qualify, but also those that are in different support departments can qualify for it as well. The key here is really substantiation. So when we're talking about phase 4 activities, clinical testing, and things like that, you want to be able to substantiate all of these really through supporting documentation. Now, there are other considerations I'd like to talk about. One is that there is an audit technique guide that is specific to the pharmaceutical industry. It's publicly available, and this is it specifically outlines the areas that agents focus on when they're conducting their audits of pharmaceutical companies. The number 2 there, LB&I directive, that's what Paul mentioned earlier about that. That is, and we just had we answered a polling question, or not a polling question, a chat question on that. The safe harbor for allowing you to use the ASC 730 financial statement R&D form to be able to claim those expenses as R&D. And then there is a coordinated issue paper, and what it does is it addresses the payments made under collaboration agreements, of which I just spoke. And so you want to make sure that you're using that as a resource as well. There's also several court cases over the past 4 or 5 years that have provided really good clarification on issues surrounding claiming the R&D credit, whether it be from a supply standpoint or from a highly compensated individual standpoint, or those that seem to be too far removed from the R&D process, like a president of a company, for instance. And there's been administrative guidance. Two of them are appearing on this list just previously. The key here is going to be establishing nexus between the activities, between the expenses that you're claiming and the activities that generated those expenses. And so you want to make sure that there's a clear nexus between those. And the key here, again, is substantiation. And to that end, the last slide in our presentation shows three general phases of a product life cycle. The concept, generation, and design phase, the testing phase, and then the recording and documenting the results phase of a study. And so this is not an all-inclusive list, but if we were conducting an R&D study for this pharma company, we would want to at least present this to them and be able to discuss what types of documentation are generated at each phase of development. And when we're talking about specific projects, we would request those documents as support for R&D being conducted on that project. But I would also say this: if you've got highly qualified individuals or highly compensated individuals, and those individuals' salaries are driving the credit, you're going to want to make sure that you build a documentation package around that individual as well. So not just focused on the projects, but on what is driving the QREs, and being able to substantiate that through documentation.
And Michael, if you don't mind, one thing to keep in mind is that a lot of times during these different stages, whether it's preclinical and discovery or clinical development or regulatory review, a lot of the documentation for R&D credit purposes is being created contemporaneously with the research. So we don't need to go in and create a bunch of new R&D specific documentation, but use what's already created within our normal day-to-day activities to substantiate the credit for our company or our client's purposes.
That's a great clarification. Thanks for that. It's really contemporaneous documentation is the definition. So you do want you don't want to be creating documents. They have less of an impact when you create them after the fact than they are when they're generated during the development. So that's a great point, and thanks for that. I just want to encourage you two things. Number one, go to our website, kbkg.com/resources, and download this presentation. But also, this was an industry-specific presentation. We do have, if you're interested in the R&D credit in general, or in a little bit more specific on how to calculate the credit, we do have an R&D 101 course that's available as well.
This concludes our presentation for today. Thanks, everyone, and have a great rest of the day.